Hey everyone, Couch Investor back to another video for today. And yes, we are already in the month of August. Pretty crazy how this year has flown by. And so we're going to go over 4 companies that I think are worth your while for this month. Now, that doesn't mean that you have to buy it. You can put it on your watch list. And I say this again and again, I'd rather buy on red days than on green days. Now, since we are in earnings season, expect volatility. When one company reports earnings, whether it's good or bad, it can affect other companies as well. So first up, I want to go over the companies that are reporting earnings this week. And I'm already going to tell you this, the 4 stocks that I'm going to mention in this video are not reporting earnings. They have already reported earnings besides one company. So we had already SoFi on Monday, which we covered on this channel. On Tuesday, before the market opens, we have Uber reporting. I think that's going to be interesting. And then for the dividend investors, Altria is reporting as well. Tuesday after the close, we have AMD, Starbucks, and Pinterest. Those are the companies that I'm watching pretty closely. I'll probably cover AMD and Pinterest tomorrow. Might be a bit later because I'm going to watch Oppenheimer. And then on Wednesday, we have, before the market opens, CVS. It's going to be very, very interesting because I'm watching this company pretty closely for dividend and a little bit of growth. Then after closing, a lot of companies. So PayPal, Shopify, Qualcomm, Unity, Robinhood, Mercado Libre, and Etsy. On Thursday, we have 2 big guys after the close, Amazon and Apple, and then Coinbase, Block, Airbnb as well. I'm probably going to cover Amazon first, then Block and Airbnb. Might all be on Thursday, might be Thursday and Friday. If you haven't subscribed to this channel yet, do hit that subscribe button. It's free. Trying to do as much as I can here. I really appreciate all your support lately, so thank you very much. Now, of course, do let me know which company you are watching closely this week with regards to earnings. All right, so now let's jump into stock number 1. Company number 1 is a company that reported earnings last week. It's a company that a lot of you have been commenting on. I never did a full video on that. Don't worry, a full video on this company will come on the channel. Stock number 1 is Enphase Energy. Enphase Energy is down 42.7% year to date. It has come down after reporting earnings as well. There's a good reason why that is. Now, there is a good reason. That doesn't mean that the price isn't fair to buy right now, especially for long-term shareholders. Now, valuation-wise, we're at a PE of close to 29 times for the next 12 months. The analyst estimates expect growth for the next couple of years and quite nice there. So for fiscal year 2023, sales is expected to grow 13.5%, EPS 9.36%. Fiscal year 2024, sales growth 25%, EPS growth 32%, and then fiscal year 2025, sales growth of 27.8% and EPS growth of close to 30%. So quite nice there. Now, what exactly has happened with Enphase? So they reported quarterly revenue of $711 million, which was down from Q1, but up year over year. Now, if we look at the rest year operating income, more than last quarter, definitely more than last year. Net income, same story there, diluted earnings per share as well. Now, they do say here that their revenue in the United States for the second quarter decreased over 12% due to macroeconomic conditions, while their revenue in Europe and also in Australia increased approximately 25% compared to the first quarter of 2023. So really nice growth internationally compared to a decrease in the United States. Keep a close eye on that. Now, a bit more information about this quarter with regards to microinverters and the battery. So the IQ8 constituted approximately 78 of our total microinverter shipments during the second quarter. In addition to the United States, we are now shipping the IQ8 microinverters into France, the Netherlands, Spain, Portugal, Poland, and Germany to support newer, higher powered solar panels. With regards to the IQ battery, shipments were 82.3 megawatt hours in the second quarter. That's a bit lower than the first quarter, which was 102.4 megawatt hours. They recently introduced the IQ batteries in Spain and Portugal and launched the IQ Battery 5P, our most profitable battery to date, in Australia, the United States, and Puerto Rico during the second quarter. Now, with regards to increasing shareholder value. So they recently completed the $500 million share repurchase program, and now they have recently reauthorized a new share buyback program, which will allow them to buy up to $1 billion worth of common stock. Now, before I talk about the big issue, I just want to mention that free cash flow is positive and growing quarter over quarter, not so much, but year over year, quite nicely there. And you can see here 6 month ending 2023 compared to 2022, there is quite a big increase there. So that is what is allowing them to buy back more shares if they want to. Now, with regards to the disaster, which was Outlook, so they expect revenue to be within the range of $550 to $600 million, which includes shipment of 80 to 100 megawatt hours of IQ batteries, GAAP gross margin to be within the range of 41 to 44%, and that's before the net IRA benefits. Now, this is much lower than this quarter's revenue and much lower than the market's expectation, but we have more information with regards to that. So during the earnings call, they did give us a bit more context. So the microinverter sell-through in the United States peaked in the fourth quarter of 2022. The sell-through in the first half of 2023 in both Q1 and Q2 was approximately 20% below the fourth quarter due to high interest rates environment in the United States. Though the sell-in to the channel was only 10% down in the first half of 2023 relative to the first quarter, we were expecting a seasonally up Q2, but that didn't materialize. This has increased the inventory in the channel, and therefore we are taking aggressive and prudent actions in the United States to manage down the channel inventory, and this is reflected in their light third quarter guidance. But they do say that they see stable high market share today for microinverters based on both internal and third-party data. So they're seeing some light at the end of the tunnel. Now I can go on and on with regards to Enphase, how they increase revenue for the future, how they'll increase free cash flow for the future. There are some big positives, but there is also one big negative for that. I'll explain all of it in a separate video because otherwise this video will be way too long and focus a lot on Enphase. So let's move on to stock number 2, and of course do share your picks for this month as well down in the comments below. Stock number 2 is a stock that has been hated a lot on the market, and I also dislike the stock, maybe the company as well, and that's why I haven't talked about it for a long time. But I think that for the short term we might see some positive catalyst there. You guessed it, it is Walt Disney. So Disney, the stock is only up 2.3% year to date. It is down 13.28% in the last 3 months. With regards to valuation, we're now at 21 times PE. And if we look at the analyst estimates, they all see some reacceleration in fiscal year 2024 when it comes to EPS. And that's one of the major reasons why I've put Disney in this list, is because of the reacceleration of the bottom line. And especially also when it comes to free cash flow, because ironically enough, because of the writers' strikes, which means less output when it comes to movies, TV shows, which could help them with free cash flow in the short term. In the long term, they'll still have a lot to figure out. But we have some news there. So there was an article that came out that says that Disney goes back to the future. Robert Iger has recently brought in 2 former heirs apparent, Kevin Mayer and Thomas Stack, for advice renewing focus on succession at the media giant. And so, what do we have here? Mr. Mayer and Mr. Stacks will help Iger think about linear TV properties like ABC. The legacy TV division is a business that Wall Street has been focused on since Mr. Iger effectively put up a for sale sign on this month by saying the unit may not be core to the company's future. A related issue is the fate of ESPN. Mr. Iger said that the company was seeking a strategic partner for the sports network. Now, before we jump further into the ESPN aspect, for those that didn't know, Mr. Mayer was head of M&A and the architect of its streaming strategy, and Mr. Staggs was CFO before leaving as their chances faded for becoming the next CEO, since Bob Chapek was chosen there and then was fired and then was replaced again by Bob Iger. Now, going back to the ESPN thing, well, there was a report that came out that ESPN held talks with NBA, NFL, and MLB in search for strategic partner, sources say. So ESPN has held early talks about a strategic partnership with the NBA, NFL, and MLB that could include the leagues taking an equity stake in the business. CEO Bob Iger talked about bringing a strategic partner into ESPN in an interview last week, and striking a deal directly with the leagues would be unprecedented, but would give ESPN a safety net that it would receive premium content from the leagues. An NBA spokesman said, "We have a long-standing relationship with Disney and look forward to continuing the discussions around the future of our partnership. I think if a deal is made here, it would be very, very well received on Wall Street." Now, of course, I know when it comes to Disney, we still have to see a lot of positive things with regards to the streaming side of things, not losing more subscribers, becoming a bit more profitable. And of course, we need to talk about the content, because the content that they've been releasing lately in the theaters or on the platform has been, well, abysmal to say the least, money losing as well. So let's see if there is a change in the near future. I think the writers' strike might actually be a blessing in disguise for them. Now, before we jump into company number 3, and of course Disney are yet to report earnings, we're going to cover that on this channel as well. Don't worry about that. Now, if you want to support me further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor, and maybe you'll find one of these companies on that list. Now, company number 3, very, very popular company, popular stock as well. I covered it weekly on this channel. If you missed the weekly video, it's going to be in the top right corner as well. And that is Tesla. Wow, surprise. I know. But since they reported earnings, the stock has gone down, around 10% or so. And to be honest, I don't really understand why. Yes, valuation-wise, traditionally, it is expensive, 68.5 times currently. But if you look at analyst estimates when it comes to growth, I mean, this year projected to do $100 billion in sales. Yes, EPS for this year, they expect a decrease. We know why: price cuts, high inflation, high interest rates, etc., etc. But for fiscal year 2024, EPS expected to grow 42.6%, fiscal year 2025, 28.5%, and by then, they'll have revenues of $160 billion, so basically 60% more than what they expect to make this year. And looking back at their quarter, of course, we covered that on the channel as well, there is a lot to like. I'm not going to go over all of it again and again, but energy is doing quite well. Gross profit in energy is doing exceptionally well as well. Free cash flow, yes, while it has increased 62% year over year, it is not really that stable. Let's hope it can stabilize in the months to come. We know that Q3 production will be a bit less than Q2 because of all the upgrades, which might mean that they'll come out with a refresh Model 3. We don't know. We hope so. We don't know when the announcement will be made. We're also waiting on the announcement of the Cybertruck pricing, that event. Who knows when that might happen. Hopefully we'll get more answers throughout Q3. But overall, I think buying Tesla during a bad week when the stock is down 10% or even more, I mean, for the long-term future, there aren't many other companies like this to own. And so we are now at stock number 4. Company number 4 has also reported earnings already, covered this various time on this channel, and that's Alphabet. Wow, another big tech company, pretty boring. Yes, I know. But this quarter gave us confirmation that Alphabet is back on track, and back on track in a big way. So yes, the stock is up 50% year to date. I said it was a no-brainer at $90. Thank you to myself. But valuation-wise, PE 21.8 times. I mean, not too shabby if you look at the analyst estimates. EPS growth for this year, 21.5%. Next year, 17.88%. Fiscal year 2025, 17% EPS growth there. I mean, quite nice. Of course, I don't think you're going to buy Alphabet because you think it's going to 10x or whatnot. But I think it's a very, very solid company to hold for the long-term future. Your shares will increase in value because they can buy back billions and billions worth of shares each and every quarter. And yes, I do think that eventually they might issue a dividend, although buying back shares is better for you, especially when it comes to taxes. But Alphabet, as we've seen, is doing quite well. Revenues increased 7% year over year. Operating income increased as well. Operating margin are now 29%, so we see a nice little increase there. Net income $18.36 billion for this quarter compared to $16 billion last year. Diluted earnings per share is up by 23 cents. And then when you look at the various segments here, finally we can see some reacceleration of growth there across the board. But the most important thing here, in my opinion, is that Google Cloud is becoming profitable and more profitable by the quarter. When it comes to revenue for Google Cloud, you can see that this part is the one that is accelerating the most. Of course, coming from a smaller base compared to Google Search, for example, that was about to happen. And if you were curious, free cash flow for this quarter, $21.77 billion. Now, before I end this video, I'll say the same thing I said at the start of this video. Yes, many of these companies have gone up 5, 10, 15% in the last week or two, and that's fine. That's what I said. Look to buy these companies or any other companies during a red day rather than green days. And I can promise you this, we're going to have a lot of green and red days throughout this earnings season. So that will be it for this video. Of course, do share your 4 picks or more down in the comments below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye bye.